so we're going to sell a put spread, okay? Once again, we're going to take in a credit. That credit is going to adjust our break-even point on the position, and any profit potential is always going to be influenced by the amount of credit that we receive. Okay, it has a defined risk and reward profile, and position monitoring is crucial. So let's look at an example. So same things. OICX is trading 150, 30 days to go to expiration. The implied volatility of the options is still rather high. It's at 50, but now maybe we're of the opinion that we're bullish. So we look at our options chain and we see that we can sell the 145 put for $5.90, as well as buy the 140 put for $4.20. When we do the math, that results in a net credit of $1.70 or 170 per spread. So from a trading standpoint, if I put this position on, I'd say, well, I'm short the 145, 140 put spread. And that infers that I'm short the more premium heavy 145 put, and I'm long the 140 put as protection. This is a neutral to bullish spread because ideally I want the stock to close above my short strike at 145. If the stock's at 150, I'd love it if it just sat at 150 or moved higher at expiration. Both options with the stock trading 150 or higher, actually even 145 or higher, both options would expire worthless, and I would keep the full $1.70 credit on this position. Once again, excluding transaction costs. So if we put this position on, we take in $1.70 to sell the 145, 140 put spread. That is our maximum gain. That's the most we can make on this position. The maximum risk, once again, it's the difference in strike. Difference in strike in this case is $5 again, the difference between 145 and 140, less the 170 we took in. When we do the math, it gets us to $3.30. So the most we can make is 170, the most we can lose is 330. Our margin is whatever our maximum loss is, in this case, $330. So if we put the spread on one time, we have to maintain $330 in our brokerage account to cover any potential losses should the stock make a big move lower and both options go in the money. If we put on 10 spreads, we would have to maintain $3,300 in our account to guard against any potential losses down the road. What is our break even? Well, our break even simply is the credit we took in, the 170. The difference in strike, well, the short strike that we have is 145. So 145 minus the 170 credit we took in, that's how we get to 143.30. So if at expiration the stock's at 143.30, in theory, we would neither make money nor lose money on this position. Once again, this excludes transaction costs. And obviously, the spread's going to be worth less with 21 days to go, and even less with 7 days to go, because remember, both of those options are comprised of 100% time premium, and in this case, Theta is our friend. Time is eroding the value of both options, but because we sold the more premium heavy 145 put, Theta is actually working in our favor. We want those options to expire and lose value. All right, so now let's look at the graph on this position. Okay, so here's that position. So short the 145 put at 590, long the 140 put at 420. Our maximum profit is that 170. That's if the stock closes at 145 or higher come expiration. Our maximum loss, if the stock goes below 140, it goes right to our long strike, or below, our maximum loss is locked in at $3.30. All right, so what happens at expiration on this position? Well, if the stock is 145 or higher, in theory, both options expire worthless, and we would keep the full $1.70 credit, or 170 per spread. If the stock closed at 150, both options theoretically are out of the money, and the position would just expire worthless. If the stock closed right at 145, just like in our call spread, okay, that's also a good situation, but we do have pin risk. So from a risk management standpoint, at a minimum, I'd probably buy back my short 145 call for a few pennies or a nickel, just so I don't have any surprises come Monday morning.